First and foremost, thank you everyone for joining today. As you're well aware, we've invited Jarrod along again. It's probably the fourth or fifth time we've had you speak, and there's a reason we keep asking you back. We like what you have to say, and we enjoy how you say it. So on behalf of Private Wealth Advisors, that's myself, Jack, Roger, Kerry and Grant. I'll stop talking and let you listen to the man you've come here to listen to. So over to you, Jarrod.
Kia ora, good morning, and thanks Ben and PWA for inviting me back. These are great sessions. I really enjoy the Q&A at the end, so please, to all the people who've dialed in, if you have any questions whatsoever, please put them in and we'll get to it at the end. That's the best part of the discussion today. It's your chance to steer the conversation where you want to go, and nothing is off the table. I'll answer any question that you fire at me. So please fire your questions through, and I'll get to them at the end. I am talking for about 25-30 minutes just to go through what I think is happening, and all the things that have hit us in the last few months. It is a very interesting time, a very difficult time for some, and quite an awkward period for the economy. But I do think things get better next year. So we're going through a very difficult period now, particularly with the rapid rise in interest rates, the correction in the housing market, cost of living crisis, cyclone. There's just so much going on, but we will get through it. Businesses are incredible at adapting to very harsh conditions, and that's what some of them are facing now. But I think next year we'll have a better balanced economy, we'll have lower interest rates, and we'll have a housing market which is gaining and recording price increases rather than falls, which is what we've seen over the last year. Now I'm just going to share my presentation. I am an economist. I can't do anything without charts. I've got to have a few charts to hide behind, and I've got a decent slide pack for you today. These are available. If you find these interesting, please reach out to Ben or myself, and I'll make these slides available to you. The title of my presentation, I think, is pretty blunt and to the point. Inflation, I think, has peaked globally. It has peaked in New Zealand. It will decline into next year. We will get disinflation across most of our goods and services, and we will see, I think, some deflation in some bits of the basket, which will be helpful. So this cost of living crisis that we're going through at the moment, where prices, particularly of essential goods and services, have been rising at a rapid rate and well above incomes, I think that reverses into next year. I think those prices increase at a slower rate. We will see some price declines in areas, but incomes will continue to grow, and we should see things getting better for households next year. And a big part of that is the Reserve Bank cutting interest rates next year. So I think the central bank is done. They've told us they're done. 5.5% is where the cash rate has peaked, and the next move is a rate cut. So that'll be good news to many businesses, many households, and of course the housing market will love that. So I'll start off with this chart. I think I've shown you these charts before, but I'm just reiterating the point here that global inflation has peaked. And if you look at what drove inflation higher, so increased demand fed through to an increase in commodity prices, particularly oil. You see that chart on the right. You see oil prices ramped up, and then they spiked higher with the war in Ukraine. Oil prices are lower. Petrol prices are lower. Petrol prices fell 8% in the last quarter in New Zealand, just in one quarter. So oil prices are lower, and that feeds into everything. So global inflation is lower than what it was. Not that long ago. It was between 10 and 11%. Now we're sub 7% global inflation. So that feeds through to us. Chart on the left, the problems we had with supply chains, that they've opened back up. So China's back in action. Shipping costs have dropped back to pre-COVID levels. When we speak to our importer and exporter clients, they're telling us that the cost of shipping is pretty close to pre-COVID levels. So there's a few more fees and bits and pieces that they're paying on the side, but the actual cost of a container is back to where it was pre-COVID. So that's good news, and that also points to the fact that shipping is a lot easier than what it was, 2 years ago. So those feed through to lower inflation globally, and then you think, well, wait a minute, what are markets saying? What are the financial markets saying on inflation? And that chart on the right there shows you the oil price, and it shows you the market's expectations of inflation over a 5-year time horizon. It doesn't matter if you pick 2-year, 5-year, 10-year, all of those expectations of future inflation have dropped. They've got further to decline as well. And you can see the actual inflation prints on that chart on the left. The one in the middle, the black line, the US, you can see US inflation has dropped from 9.1% to 4%. So they're almost leading the way in what we're expecting to see with inflation rates. So New Zealand's inflation peaked at 7.3%. The latest read is 6.7%. This time next year, it'll be 3% if our forecasts are close to being right. So that downshift is important, and it's coming on the back of some weak growth. So we're seeing recessions in parts of the world starting to happen, and we're seeing a significant downgrade in global growth expectations, even into next year and the year after. Really high interest rates are having an impact on the global economy, and that has an impact on a small open economy like New Zealand. So our inflation forecasts are pretty similar to the last time we had this chat, that they're peaking, and we're seeing inflation coming off into next year. There are different ways to look at the inflation basket. One way is to look at the international prices that we pay. So half of the inflation that we have experienced over the last few years has come from offshore. That half of the basket is going to be much weaker over the year ahead. So those international prices that we're paying, they're going to fall into next year. So we will see some deflation within that basket, and we'll see, the inflation rate of tradable goods coming right back towards zero. Locally generated inflation, a lot of it came out of the housing market. Some more of it will come out of the rebuild from the cyclone, and even more will come from the migration boom and the government spending. So there is quite a bit of inflation domestically. That half of the equation is going to be frustrating. We do see non-tradables, domestically generated inflation coming off. So inflation rates will ease. Prices will still be increasing this time next year, but just not at the same rate as what we're experiencing today. And that is being translated into people's expectations of where inflation's going to go. So when you fill in the Reserve Bank survey, and I fill it in, most analysts do, and there are senior, CEO type figures from a number of businesses who fill in this survey, you can see that expectations of where inflation is going to be in the future, whether it's 1 year, 2 year, 10 year, have all eased. And that's good news for the central bank because they're concerned that inflation expectations will fuel further inflation in the future. But it looks like expectations of inflation have dropped, and that's quite important for the central bank. It's a psychological thing, getting inflation expectations lower, and it looks like that's happening. So what does that mean for monetary policy? Well, if inflation has peaked and it looks like it's going to be at sort of 3% this time next year, well, job done. We're forecasting inflation to fall back to 2% by the end of next year or into 2025. Monetary policy today is setting conditions for the next 18 months to 2 years. So they've set the cash rate at 5.5 in anticipation of that feeding through the economy over the next 18 months, and they are comfortable that they have done enough to get the inflation beast under control. And I think they have too. I actually think they've done more than enough. I actually think they have tightened a little bit too much. Interest rates are a little too high. The negative feedback from households and businesses is quite clear, and has been very clear to me over the last 9 months that there is a big shift in the economy. And I'm actually out there saying the next move is a rate cut. That's controversial for some. You have other commentators calling for more hikes. I disagree. I think that the Reserve Bank's been very clear 5.5 is the peak. So if it's the peak, then the next move's a cut. It's just about timing that cut. The Reserve Bank thinks that they'll leave the cash rate on hold for at least a year and start cutting in the second half of next year. I think things will develop in a way where the central bank will actually be in a position to start cutting in February next year. So it still sounds like a while away, but from their last hike in May to February, you've got that 9 months time to assess, to wait and watch, and to see if inflation is actually falling to where you think it's going to fall. And if it does, then I think the next move is a rate cut, and it starts in February. So you can see chart on the left there is our expectations at Kiwibank, the market's expectations are, and what the Reserve Bank's expectations are. And the market's kind of in between the Reserve Bank and us at Kiwibank. And I think the market will ultimately move down to our forecasts, and the Reserve Bank, will ultimately move down to our forecast if we're right in the slowdown that we're seeing. Chart on the right there just shows, hey, there are risks to either side of this. There are upside risks if migration causes more inflation, or the cyclone rebuild is more inflationary, government spending, does more than we think, that sort of stuff. There's upside risk, and the other commentators may be right, and that we get another 50 basis points. I think this call for another 25 basis points is wrong. I think the Reserve Bank, if they find themselves in a position that they need to hike again, 25 basis points is not going to do it. They'll probably have to deliver 50. So that's what we're saying. If that's an upside scenario, we put more weight on the downside scenario, which is one where they start cutting at the same time, or potentially in November this year, and they have to cut to stimulatory levels. That has got more weighting for me than the upside. I'll put 10% chance on the upside, about 35% chance on the downside, and the rest is our central scenario. So that's what we're talking through with clients, and what that means for interest rates and currency, and it's what we go through as a bank when we're looking at hedging our interest rate risk or other risk over the next year. We sort of look at these scenarios and we weight them, and away we go from there. What it means is that I think the mortgage rates that we've seen will be the peak, actually. And I think we have seen, some 2 to 5 year mortgage rates coming off. That's reflecting market pricing coming down. And I think that we will see all mortgage rates falling into next year. And if the Reserve Bank does deliver a rate cut in February next year, it's not one cut. The market's going to factor in, at least 100, 200 basis points of cuts. You will see those 1 year, 2 year mortgage rates dropping quite quickly before that cut's delivered, but also while they're delivering cuts, you'll see mortgage rates falling into next year. So the pain that people are feeling now as they're rolling off very low rates, we had record low interest rates 2 years ago, record low with, over 100 years worth of data here, 10,000 years of data globally. That's the record low on interest rates ever. And now we're going back to something more normal, but more normal for some people who've only been in the game for a few years, that hurts. So people are rolling off these very low rates onto high rates. Now we're saying, hey, look, you just got to survive for the next year, and we think that interest rates will be coming off. The chart on the right there shows you that basically half of our mortgage book has rolled off onto higher rates. The other half of our mortgage book rolls off in the next six to 9 months. So, there are people who are still rolling onto higher rates and still about to wear the cost of higher interest rates. And that's feeding through to disposable income. So people's ability to spend is being restricted by not only the cost of living crisis that's going on, people spending more and getting less. That's a big problem. But those that have debt, the percentage of their income that they're spending on that debt, servicing that debt, paying interest, is rising quite quickly, and it'll be over 20%. So what does 20% actually mean? Well, there are those that have been in the market for a long time and have, relatively small mortgage, so it's a relatively small number. But then when you think of averages, there are people who have entered the market in the last, 3 or 4 years, and it's a much higher percentage. It could be, 30, 40% plus. So that average just gives you a line in the sand. What it shows you is that those people who've been in the mortgage market for only a few years are coming into some stress now. You have to talk about the cyclone. The cyclone, we're rebuilding. It will take years. It'll be a bit of a flurry of activity as we are rebuilding and putting fences back up and trying to get crops, sorted for the next year. That sort of stuff will cause a bit more activity, might cause a little bit of inflation, probably not much. But I think what this is doing from a medium-term perspective is it's accelerating the conversation around climate change. And I think you'll see insurance companies charging more and more. The premiums will go up in areas of high risk, and that may cause some issues for us as banks. If they actually come out and say, well, we've increased the premiums, but we still don't really want to insure this area. We're going to put exclusions in there, so we'll insure you for X, Y, Z, but we won't insure you for flooding. Then that poses a risk for us as banks. We want our mortgaged assets to be insured. So there may be issues, I think, coming to the surface over the next 5 years with certain areas of the country, won't get insurance and potentially won't get a mortgage. So that's something we're going to have to discuss, I think, in more detail, and that's a very awkward conversation to have with clients. Government, they're spending more. Look, it's not a big deal as far as I'm concerned. Debt levels are very low, really low debt levels. I think there's actually more that they could be doing on the infrastructure side. It is an election year. It will be interesting to see how that plays out and what a potential change in government will do. But from our perspective, what the government is doing is it's not bad. There is an increase in expenditure as you'd expect with a cyclone. There's just a very low level of debt. I'm happy to discuss that in the Q&A. It's a very low level of debt. We shouldn't be worried. We are forecasting a lift in the unemployment rate. So we are going through a technical recession. It's not a bad recession, but it is a recession. You would have heard, there was a 0.1 contraction in the first quarter, so a tiny contraction, but it followed quite a significant contraction in the fourth quarter of 0.7. Compared to where the Reserve Bank was thinking. They were thinking plus 0.7, came in at minus 0.7. That's a big miss. First quarter was the same. Central Bank was thinking 0.3. It came in at minus 0.1. It's more about where the economy was expected to be and where it ended up. And it's much lower than anyone was forecasting, especially the Reserve Bank, especially Treasury. Treasury is quite upbeat in their assessment. And their tax take, their income, the government's income is coming in lower than forecast. And it's on GST and it's on company tax, corporate tax. So those big misses are very clear signal that the economy slowed dramatically 9 months ago and will continue to bounce around at very weak levels over the year ahead. That's going to generate some unemployment, unfortunately. Not a lot, but a lift in unemployment nonetheless. And that is kind of what the Reserve Bank's trying to engineer, trying to get this slowdown in the economy to make sure inflation is lower this time next year. And when you talk to businesses, people on the line today, the discussion really has changed in the last 9 months. So 9 months ago, the discussion was, geez, there's massive inflation pressure. Our wage bills are going up. We're trying to hire the right worker. We're trying to retain our workforce. And to do that, we're having to spend a lot more, on wages and benefits and everything like that. Now the discussion's actually shifted. It's more towards, we're a little bit worried about revenue. We're worried about the order book. We're worried about our future, income. We're still dealing with this cost pressure, but we're more worried about income and growth from here. And you ask businesses, are you investing? No. We don't have the confidence for that. Are you hiring? Actually, they've gone from really screaming out for workers to actually, we're hearing more and more from businesses actually downsizing and reducing their workforce, and that kills growth very quickly. And you can see that, as I said last year, the biggest problem was labor. Now the problem that they're facing is more on the demand for their product or service rather than labor. Same thing can be said for consumer confidence. This is a Westpac survey. It's quite a good one. Goes back to the 80s, and it shows that consumer confidence is really low. Cost of living crisis is hurting. Interest rates are hurting. House prices are falling, which impacts confidence. And you can see here that confidence is at levels that reflect the recession and have been for a while. So, most of us have been calling for a recession. It actually came earlier than we thought. We thought the recession would start about now, midway through the year, and we're still expecting a couple of contractions in growth over the second half of this year. But the base where we came from is much weaker than we all thought. So, the impact of Reserve Bank actions have been very swift. Some good news in all of this. It's not bad news all the time. Unfortunately, it's that there are some green shoots developing, and I really like the chart on the right. There were a number of people during COVID who said tourism will never bounce back. Tourism will never be what it was. This has changed the world forever. People won't come back to New Zealand. Load of rubbish, absolute rubbish. We are 75% back to where we were pre-COVID already. We've only had the borders open for 5 minutes and tourists have come flooding back. And they always were. They always were going to come back. New Zealand has not changed. We're still the most beautiful country in the world. Our rivers, our lakes, our mountains, our bridges that people like to jump off with a bungee attached to them, all still here. Hasn't changed. If anything, New Zealand's brand as a place that you want to come to has increased over the COVID period. So I'm expecting tourism numbers to actually go higher than pre-COVID levels, not just to go back to pre-COVID levels, but actually to go higher. So that is great news for our customers in Queenstown, for example, Rotorua, other areas around New Zealand. They are seeing quite a sharp bounce back in tourism, which is fantastic. That's been the missing piece of the puzzle for a while, and tourism will add quite a lot to the economy over coming years. On top of that, same thing, but not tourists, actually people who want to move here. We're in the middle of another migration boom. We've seen 72,000 net migrants come into the country in the last year. This time last year, there was an outflow of 20,000 Kiwis overseas. We're still seeing the outflow of Kiwis, but we're seeing more and more Asian migrants coming in and looking for work. So we're actually back to very high levels of migration, which is actually helping the labour market. So the labour market, we're seeing people coming in on this lower to middle income bands and taking up, the jobs that businesses were screaming out for, only 6 months ago. These jobs are now being filled, which is very good news in terms of the labour market. Puts less pressure on wages, so again that helps the inflation story. Adds to inflation in other areas, particularly housing, but I think it's a net positive, and it's a net positive for inflation. Where do we see the housing market going? Well, I think we're near a bottom. I think we will record the bottom in house prices in coming months, and I think we'll come in spring and summer. We'll see a lot more activity. We'll see house prices starting to lift again. Potentially by the end of this year, but we think definitely over 2024. The bottom of the housing market will be recorded with the peak in interest rates. As interest rates decline into next year, that'll help the housing market recover. The fact we've got all these migrants coming adds to demand in the market, and the fact that regulatory changes more in favour of relaxing LVR restrictions and other things, particularly if we get a change in government, then again that'll support the housing market into next year. So we've actually grown a lot more confident. We had forecast a 20% decline in house prices. We're at about 17% now. That little bit extra we still think will come through, but we are forming a base. We've seen activity start to pick up again. We are going into the winter months, which doesn't help. So we're going to have to really wait until spring to see whether activity picks up, and I think it will. We're hearing anecdotes that we're seeing more buyers coming in. The market's a bit better balanced than what it was, and I think we'll see things lifting, and that's quite important for confidence into next year. So to sort of summarize that, the housing market improving into next year, interest rates, key part of that equation, a key part of the story is interest rates falling, not rising from here. Different to what other commentators are saying, but I'm quite confident that the next move in interest rates is lower and that will help the economy next year. That's me, half an hour bang on, and please, I'll open up to Q&A. Ask whatever questions you have.
All right. Well, I've got a few to go with, but I'll start with Steve's here. So, how material is government sector productivity to inflation numbers? Government sector is growing, but if the service delivery drops, appears to be the case anecdotally, are we not paying more for less service? But is it material?
Yeah, it's a very. I mean, productivity is a the holy grail for economists, right? We need to see productivity gains in order to see gains in our standard of living. So that comment about not getting as much out of the government for bang for buck, issues around productivity, particularly in the public sector, is a very good point. There is a lot of inflation out there, so the costs of the government doing things have increased quite a lot, and that's broadly across the whole economy. So that is an issue. What we, I guess, need to see is the government actually delivering on what they say they're going to do. You would have heard post-budget, most economists came out and said, "Oh, it looks like the government's spending more than we thought in their proposal." But if you actually look at what they have done, there's been an underspend. So they haven't actually got money out the door in a way that they thought. And I think that will continue, actually. I think they're struggling to get stuff done, as most governments do. But there has been an underspend, and I think that'll continue. So when we look at the government, we think, are they contributing to the economy or are they taking away? They're telling us they're going to take away in the future, but right now they're contributing. So that is inflationary, but what we've seen is it's actually less inflationary than we thought. So from that point of view, the government's fiscal impulse, that sort of thing, is meant to be quite strong over the next year. But I think there's going to be an underspend again, to be fair. And I don't think it's as inflationary as other commentators have suggested.
Changing government, what impact do you think that might have?
So broadly speaking, New Zealand's governments are quite central. So whether you get Labour or National, they're not the extremes, right? They're not like what we're seeing and it's not like voting for Trump or some of these other characters around the world. Relatively central, but obviously National is more pro-business, definitely seen as being more pro-business, and more pro the removal of regulation rather than the adding of regulation and that sort of stuff. So I think if history is any guide, national government comes in, that'll put more confidence into businesses. We'll see probably a higher rate of house price depreciation under National than we would under Labour. Other than that, they're reasonably central. But I think that the market, financial markets, businesses, and those in the housing market would prefer a national outcome.
On the government front, particularly with the tax policies that have been announced, we've seen from obviously the Greens what policy they want to put in place. Can we afford as a country not to increase tax rates?
I think there's a number of things we need to look at, and I'm disappointed that both sides of the government refuse to look at the demographics of this country going forward. Other countries like Australia are looking at it and preparing for it. We have an aging population. We have more people over the age of 65 every year and fewer people underneath to support those at those older age brackets. It's a common problem globally, right? We've all got aging populations. Take a look at China. Their population has peaked. India's population doesn't peak until 2050, but take a look at China. Their population's peaked already. It's a big burden that we have to look at going forward. So yes, we are going to have to either increase taxes or add taxes to people retiring or whether it's capital gains or whatever. There's going to be an increase in tax. The simple answer from my point of view is increase the retirement age. This government's kicked the can down the road. The next government might do it as well. Mathematically, you have to increase the retirement age. The Australians are increasing their retirement age to 67, and I believe they're increasing it again to 70 in 2035. This is already locked in, right? We are going to have to do the same thing. Yeah. I'm 45, and I do not expect to be able to, retire until 70. I think that's the retirement age it will be by the time I get there. It just has to happen, and that's one of the biggest challenges and one of the easiest things to do. But both governments are afraid of dealing with that issue.
Is there a risk on our national credit rating if we don't act soon enough?
There's a risk on our national credit rating, given the size of our current account deficit. And yes, if we don't do this, it could be more of a risk. But don't forget, our starting point is super strong. We are AAA rated, AA plus. That is as high as it gets. There are only 10 nations globally that have such a high rating. The US is not one of them. The UK is not one of them. Most of Europe are a mile away from being, AA plus, AAA rated. So we're in this very elite group of countries. And if we lose that credit rating, I'm not really worried about that. The UK had a double notch downgrade following Brexit, and the UK is still the UK, right? So yes, I think our credit rating is super strong, and there are threats to it, particularly around the demographics that we face, but I'm not worried about it, because from a government's point of view, we have tiny amount of debt. 20% of GDP net debt compares to 40% in Australia, 100% in the UK and the US, and 260% in Japan. So you've got to put this in perspective.
So then rolling on that brings in another question we've got here. So local government budgets under pressure with the historical lack of infrastructure spend, ratings revenue topping out. Is there a case for more financial support from central governments for local governments, particularly in that investment space?
Absolutely, 100%. They should be doing more. The government should be providing more support. So all of that I just said before about how we've got really low levels of debt, blah, 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 that's the government, that's central government. Local councils, local governments are up to their eyeballs in debt and have, for whatever reasons, underspent on infrastructure for decades. And as a nation, we have underspent on infrastructure for decades. We haven't even kept up with the population that we've got, let alone thinking about the population we will have, with charts like what I showed you before. Between 2014, 2019, that was the largest migration boom New Zealand's recorded, right, going right back to the 1800s. There was a very large migration boom around that 2001 to 2003, but that was dwarfed by this one. And now look at where we are on this chart. We're heading back to a very high and large migration boom. We're letting all these people in. Great, they're filling jobs, they're productive members of the economy. Fantastic. We're not building enough houses for them. We're not keeping the roads, rail, healthcare, education. We're not keeping up. And we'll make the same mistake over and over. We made that mistake in 2000 on this chart. We made it again in 2014 to 19, and we'll make it again in 2023 to 2026.
Alrighty, so changing tack a little bit here, just reading one of these questions. Do you have any data on attrition through the COVID recession period? That is business failures, mortgage failures. Agree that businesses are amazing and adapt well, but what's the actual situation regarding the casualties of this period?
So I haven't looked at the proper data, sorry, but from a Kiwibank perspective, it was really low. We thought we would lose a lot more businesses than we did. Obviously, there were a few, tourism type businesses, restaurants, cafes, these sorts of things. And to put it bluntly, you do see failures in these areas, but they do tend to bounce back. Whether they see these failures, but then we'll see another cafe popping up in the same spot later on, or we'll see another tourism operator popping up in the same spot. So yes, some businesses really struggled. Most businesses, most of our customers actually managed to adapt. And we're now actually at the other, well, the last since COVID, the last sort of year and a half, these cafes, these restaurants, one of our customers in Queenstown owns, 4 pubs and bits and pieces, and he's only been able to open 2 because he doesn't have the staff and he doesn't have the ability to run. So there's actually more capacity issues now around getting back up and running than the failures in that we saw. So on the business side, we didn't see a lot. I'm not sure what the national figures showed, but I don't think it was a lot. On the household side, rounding error, and I really mean rounding error. The level of defaults that we saw, over the last 4 or 5 years have actually been, lower than normal. So defaults are picking up now, back to more normal levels. But COVID was actually, I was just looking at these stats this morning. COVID was actually a super low period for household stress, ironically.
Okay. And yeah, so jumping on to just a follow-up question there. Can you see that one, Jarrod, or is it easier for me to read it?
Oh, sorry, I don't even know where is it on
That's cool.
chat?
No, I'll read it out verbatim. That's all good. So,
Yeah.
the rest of our conversation, Grass, today has rightly enough been on the 5-year horizon. How much work do you think is being done in the market on contingency planning for fairly predictable disruptions, such as continuing extreme weather, AI, future pandemics, potential for war in Europe, etc.? Would it be fair to say not much, that the boards are focusing on the immediate only?
Yeah, I would agree with that statement. And geez, there's a lot packed into that question. I would agree. Yes, we tend to get swamped and trying to deal with the here and now. So I showed you those survey answers before that that sort of gave you a feel, I think, for what businesses are thinking. At the moment, that chart on the right there, the experience costs, are much higher. We're dealing with a higher inflationary environment. Can we pass that on to our customers? The answer in that chart there is probably not as much as we would like, because the thoughts on profitability are going south as costs have gone north. So that's an ugly situation to be in from a business, and that does force generally the old blinkers on, that old tunnel vision, dealing with the here and now. And the chart on the left there, asking businesses, are you hiring? Well, actually, that went negative for a little bit. It's now bounced slightly positive. Are you hiring? Are you expanding? No. Are you investing in the future for what you've just mentioned in that question? Climate change issues, AI, all that sort of stuff coming through. The answer is no. According to these surveys, surely there are many businesses that do look at that far, but generally speaking, I would say the blinkers are on right now, and the disruptions that you mentioned are massive. So from a bank's perspective, climate change risks, the modeling that we've been given from NIWA around certain areas. There are homes that we have mortgages on that we might have to turn around one day and say, we can't put a mortgage on this anymore. That's going to be a really tough conversation. Climate change, it is a big deal, whether you believe the science or not. The fact that we're getting warmer temperatures and more disruptive weather, I think most people will agree that if it continues, and we all think it will, there's a lot more that we have to do from a personal perspective, but also from a business perspective. And then you mentioned AI. Geez, have you got an hour? Because AI is massive, and the way AI is going to disrupt many businesses, including banks, could potentially be absolute game changing for all of us, everyone, every business, every industry. There's going to be, AI is coming. It's going to, we hope, enable more than it does destroy. So I think from an economist perspective, I could be replaced by an AI bot, that forecasts, that writes commentary, that even, potentially delivers presentations like this. I hope rather than replacing me, it will enable me to do more, just with the other technologies we've seen, over hundreds of years. Those massive improvements in technology generally enable people to do more than they replace and destroy. So there are definitely going to be areas that are replaced. Driving, for instance, is a skill that we don't need. So driving cars, taxis, Ubers, these people, that they'll be automated out with automated cars in itself. Truck drivers, train drivers, pilots, all these sorts of people. These are skills that I don't think we will need and probably won't have in 20, 30 years' time. And that's just one example of technology that we're all familiar with, and that's driverless cars. What about all the other stuff that hasn't been invented yet? I think AI is going to be hugely disruptive, and I'm hoping it's going to be hugely, positive. But there will be some big productivity gains through this period as well.
Shifting away further afield now, I've still got probably 10 minutes left, so I'll wait for a few more questions to come through. But China, there was a bit of, in the previous question, there's a little bit about geopolitics with Europe, but China, potentially their lack of growth or haven't quite come out of the gates as fast as we would have thought. What risks what are the key sort of risks you see out of China, their growth, lack thereof, whatever's happening with their demographics, and any potential of the tensions between the US and where that might leave us?
Yeah. So economically speaking, it's kind of the same, I guess. But from their outlook, their population has peaked, so they're simply not going to grow as fast as they did over the last 40 years. And I don't think anyone would assume that was the case anyway. They're going to grow at a much lower clip. Their potential is declining. As a number one trading partner to New Zealand, that's important. They are our number one trading partner. They're our best source of income. Their economy is proving to be quite weak at the moment. Inflation in China is really low, so that's good for the stuff that we import for them. They have opened back up, obviously, but the growth that they're getting is much more subdued. They're not as the credit conditions are not as easy over there. We are going to get growth out of China, but it's not going to be the rates that people hope for. Geopolitically, China worries me more than any other country in the world, and has for a while. One thing I've been hinting at for a very long time now is we need to diversify away from China. It's our number one trading partner, very good, fantastic, but in bad times, geez, it's a bad trading partner. If we remember what happened in 2008, when China just stopped the boats from Australia, said, we're done for now. That caused massive stress across some miners in Australia. They are a very brutal trading partner. Fantastic in the good times, really good in the good times, but they're bad in the bad times as well. And I worry about the geopolitical tensions between China and the United States. This is all happening in our backyard. You know, the China Sea, this sort of tension. I think there could easily be a mistake made from either side that causes an issue, and New Zealand finds itself between a rock and a hard place. Number one trading partner, have to maintain that relationship. Geopolitically, though, you know, we're obviously aligned with the West, with the US. We will find ourselves, as Australia has already, in a very tight situation at times. So I think, yes, China worries me more than anyone else in the world right now. Obviously, the war in Ukraine and Russia and all that sort of stuff. Yep, but that's a bit far removed for us. China's in our backyard, and how that plays out, you know, over the next 5-10 years, that'll be our war. That'll be our issue that we'll have to grapple with.
Yeah. Alrighty, well, I might as well just throw one more question at you, then probably wind up unless something else comes through. And bringing that back locally, you talked obviously the residential space. In terms of commercial property, have you got any views on stress in that particular world, and how you see that playing out, particularly with bank lending, revaluations, breaching covenants, and all those sorts of things, and the level of stress that could come through?
Yeah, we've seen, you know, quite a shift over the last year and a half. Obviously, some commercial property has been more impacted than others. You know, stuff in the CBD, stuff that's been impacted by, you know, the COVID changes, this working from home. There are some commercial properties which, you know, are just not performing, and will probably take a long time to come back. When I talk to our property finance team, they're telling me, look, you know, deals that would have been done, you know, this time last year or at the start of last year, or 2021, 22 sort of stuff, are not getting done now because, you know, interest rates have lifted and the numbers don't stack up anymore. I would say in terms of credit appetite, I think Kiwibank, well, I know Kiwibank's probably got a higher appetite to get involved in that space compared to others, and what we're hearing from others. But, you know, Kiwibank's the 5th largest bank, right? If the top 4 are, you know, being a bit more conservative, then, you know, that means the whole market is simply a lot more conservative, and the risk appetite of banks is lower, even though Kiwibank's got a higher appetite at the moment. You know, it points to, you know, slowdown still in that area, and I think, you know, it's hard to just turn around and say commercial property is going to bounce back or not. There'll be some areas that will continue to struggle, and there'll be some areas that will you know, significantly outperform. But broadly speaking, talking to our you know, property finance group, you know, it seems like it's harder getting a lot of deals across the board at the moment, particularly with the lift in interest rates and serviceability requirements.
Absolutely. Well, thank you very much. I think we'll probably pull the pin on this one now. As always, much appreciated. Enjoy listening to what you have to say. Always clear and concise, and that's a valuable skill to have in your role. I say on behalf of the guests, thank you for joining us and talking to us today. Thank you for those that joined us. From myself, Kerry, Roger, Grant, and Jack, and those at Private Wealth Advisors, thank you once again. And I'm sure we'll be knocking on your door soon to hit you up for another update.
Fantastic. Thanks for having me. Awesome. And thanks for the questions.
Appreciate it. Cheers, Jarrod. Catch you later.
Cheers.
Bye.